So what's really happening in the African startup scene? I mean, on one hand, you've got this incredible, exciting story of opportunity and massive growth, but on the other, there's a much tougher, more complicated reality for the founders on the ground, and some pretty surprising twists in the funding data. Let's dig in and really unpack what's going on.
You know, this quote just perfectly captures this huge shift in thinking. The whole conversation is moving away from dependency and aid, and it's moving towards investment, potential, and building the future. This is the continent's root pitch, and honestly, it's a powerful one.
So what's driving this new vision? Well, a huge piece of the puzzle is technology. The world has become way more connected than it has ever been, and that simple fact is unlocking some absolutely incredible opportunities all across Africa.
I mean, this right here shows you just how massive that shift is. It wasn't that long ago, just over a decade, we were measuring global connectivity in megabits. Today, we measure it in gigabits. That's an exponential leap that has made the world feel so much smaller, allowing information and ideas to flow faster than we ever thought possible.
And you know, this connectivity isn't just about bits and bytes of data. It's about culture. In this new, more decentralized world, African food, fashion, music, it can all reach a global audience directly. This cultural export is actually creating brand new digital platforms and enormous economic value. It's a whole new way of looking at global markets.
Okay, so that's the exciting 30,000-foot view. But now let's zoom way in. Let's get down to the personal, often really challenging journey of an entrepreneur who's trying to build something on that promise.
And this is the million-dollar question, right? It's one thing to talk about big global trends, but what does it actually feel like for that founder on the ground? Well, the experience is often way more complex and, frankly, more isolating than any pitch deck will ever let on.
And this brings us to this really powerful metaphor, the cocoon. Think about it. It's that messy, confusing, in-between stage. You have a prototype, but you don't have a real, sustainable business yet. All the old rules have dissolved, but the new structure, the new identity, it isn't fully formed. It's a period of intense and often painful reformation.
And here's the hard truth that a lot of founders in that cocoon stage run into. Building something cool is not enough. They discover that the prototype they've poured their heart and soul into, well, it's hitting a wall in the market. A product that nobody is willing to pay for is a project, not a business.
So how do you actually support founders through such a delicate stage? Well, a new model is starting to emerge, and it's called Stewardship-First Capital. It's built on 3 core ideas. First, giving founders capital that empowers them, not entraps them. Second, focusing on building sustainable systems instead of just surviving on hustle and adrenaline. And third, providing financial structures that are patient but also precise.
And you can see the pathway out of the cocoon right here. It doesn't start with a slick, polished pitch. It starts with just raw honesty about where the business really is. From there, you work together to map out the fundamentals, things like unit economics and market validation. And only then do you enter a partnership that provides the right kind of capital and support needed for this fragile stage.
Okay, so with that founder-first reality in our minds, let's zoom back out to the macro level and look at the money. After a pretty tough couple of years, the funding landscape is changing again. But what is the data really telling us?
Now, the numbers we're about to jump into, they come from Disrupt Africa's big annual funding report. It's really the benchmark for understanding how capital is flowing into the continent's tech scene.
And here it is, the headline number. In the last year, African tech startups raised over $1.6 billion. After a really painful funding winter, this is a huge signal that capital is flowing back into the ecosystem in a big, big way.
So let's put that into context. After 2 straight years of decline, this past year saw a massive 46.2% rebound in total funding. Now, on the surface, that looks amazing, right? It looks like the tough times are over and it's full steam ahead. But the story's a little more complicated.
Because when you dig just one layer deeper, a really critical question pops up. Is this comeback lifting all the boats equally, or is the money actually becoming more concentrated?
And here it is, the central paradox of this whole thing. While the total amount of funding soared, the actual number of startups that got any funding fell by 11%. So what does that mean? It means more money is going to fewer companies. Investors are placing bigger bets on what they see as safe havens.
You can see that concentration pretty clearly on this map. A staggering 88% of all funding went to the big 4 markets: Nigeria, Egypt, South Africa, and Kenya. That left just 12% to be shared among the rest of the entire continent. And we see the exact same pattern when we look at sectors. Fintech is still the undisputed king, pulling in almost 43% of all capital. And when you add energy and e-commerce to that, you realize that just 3 sectors accounted for over 70% of all the money. The concentration is just undeniable.
Now here's a trend that is particularly concerning. The percentage of funded startups that had at least one female co-founder, it dropped to just under 17%. That is a major fall from previous years. It's a pretty clear sign that this funding rebound isn't lifting everyone up, and that gender diversity has actually taken a big step backwards.
So let's try to connect all the dots here. We've got this incredible vision of Africa as a global destination for opportunity. We've got the harsh, on-the-ground reality of the founder's cocoon. And we've got a funding landscape that is both bouncing back and, at the same time, concentrating. And this brings us to a really crucial distinction. See, the dominant venture capital model, it's often looking for that explosive, super rapid growth. But for a founder who's stuck in that cocoon, what they really need is stewardship capital, that patient money that's focused on building sustainable systems and finding real product-market fit.
And this is maybe the most important message to take away from that difficult early stage. The cocoon isn't a sign of failure. It is the process of formation. The founders who can successfully get through this stage, they're the ones who are going to build the resilient, generation-defining companies of the future.
And that leaves us with this one final critical question. The data shows us the money is back, for sure. But as it concentrates into bigger and bigger checks for fewer, later-stage companies, we have to ask ourselves, is it the right kind of capital to support the thousands of founders still in that crucial, formative cocoon, ready to build Africa's future?